In this video, we continue our discussion on Chapter 12, in which we go over market outcomes, where in our last video we went through the profit maximization process for a monopolistically competitive firm. In today's video, we seek to go over market outcomes for the monopolistically competitive market structure by going over some preliminaries in order to discuss the short-run equilibrium as well as long-run equilibrium for the monopolistically competitive market structure, and then conclude with market outcomes by comparing the monopolistically and perfectly competitive market structures in terms of their equilibria. So to begin, in regards to our preliminaries, we saw the profit maximization process for a monopolistically competitive firm. Now we seek to extend this to look at the overall market, where to do so, let us first consider the short-run equilibrium for the overall industry as well as for an individual coffee shop, where on the left we have our iced coffee industry and on the right we have our individual coffee shop. Price is going to be on the vertical axis, quantity of iced coffee on the horizontal axis. In terms of our market for iced coffees, we have market demand that is downward sloping, inverse relationship between price and quantity. We also have our downward sloping marginal revenue curve that's strictly below market demand. And we have our upward sloping market supply curve, positive relationship between price and quantity, and this can correspond to the sum of marginal cost curves for our individual coffee shops. Equilibrium for this market occurs at the intersection of marginal revenue and market supply, which gives us the quantity level IC1, where since this industry has market power, similar to what we did with the oligopoly and monopoly market structures, we then use this quantity level to move up towards market demand in order to find our price point in terms of what households are willing and able to pay, which gives us our price point P1. So in market equilibrium for the monopolistically competitive industry for iced coffee, we have an IC1 level of quantity and a price point of P1. How this translates to the individual coffee shop on the right, similar to what we did with the profit maximization process in our prior video, we have our downward sloping demand curve for the iced coffee of this particular iced coffee shop, their downward sloping marginal revenue curve below the demand curve, a U-shaped average total cost curve in which it's downward sloping when average fixed cost is dominant and upward sloping when average variable cost is dominant. We then have our upward sloping marginal cost curve due to diminishing marginal returns. Profit maximization occurs at the intersection of marginal cost and marginal revenue, which determines our output level for this individual firm, corresponding to an output level ICA. And since this firm has some market power, they then price using what households are willing and able to pay at that output level on the demand curve corresponding to a price point PA. And then in terms of determining profits, as we did in the prior video as well, this is going to be a matter of using our formula, the difference between price and average total cost, and scaling by quantity, where we see our pricing strategy on the demand curve is strictly above the point on the average total cost curve, or that PA is strictly larger than CA, such that profits per unit is positive, such that when we scale by our quantity level ICA, we'll have a positive amount of economic profits, as we saw in video 2. So then overall, with this market equilibrium in the short run, we saw that positive economic profits exist for individual coffee shops, and the condition that satisfied the short run equilibrium was marginal revenue is equal to marginal cost, or our profit maximization rule, where since positive economic profits exist in the short-run equilibrium for the iced coffee industry and low barriers to entry occur in this market, new firms have incentives to enter the market, just as we saw with the perfectly competitive market structure, where with new firm entrance, this will then correspond to a rightward shift in market supply, leading to an adjustment to a new market equilibrium for our iced coffee industry, which will also have the effect of corresponding to a leftward shift in the demand for an individual coffee shop due to the reduction in market share, and an overall adjustment in the profit maximization process for an individual coffee shop. Using this firm entrance and examining the process of a rightward shift in market supply and leftward shift in individual coffee demand, we can establish our long-run equilibrium. And so let us work through this graphically, where on our leftmost graph, we have our iced coffee industry. On the middle graph, we have our leftward shift in the demand curve for an individual coffee shop, which will then allow us to examine our profit maximization process for an individual coffee shop on the right. So beginning with our iced coffee industry. We have our initial curves from before, downward sloping market demand, downward sloping marginal revenue, and our initial upward sloping market supply curve. Marginal revenue is equal to market supply, giving us our initial quantity level in equilibrium, pricing at our initial market demand curve, giving us our corresponding price point. Since positive economic profits exist for an individual firm and the low barriers to entry exist in this market space, new firms enter, corresponding to a rightward shift in market supply, where after this market adjusts to a new equilibrium at the intersection of marginal revenue and this new market supply curve or new industry marginal cost curve, we generate a new quantity level, which we see is going to be strictly greater than our previous quantity level in equilibrium. And in terms of finding our new price point, moving up along our market demand curve at that quantity level to find our pricing strategy, we see that this corresponds to a price point P2, where P2 is strictly less than P1. So at this new equilibrium, due to firm entrance, we have an increased quantity level and a decreased price point for our iced coffees overall. Where at the same time, due to this new firm entrance, this corresponds to a leftward shift in the demand curve that an individual coffee shop faces. Where when we begin looking at this effect at our individual coffee shop, we have our initial U-shaped average total cost curve and our upward sloping marginal cost curve as before, as well as our initial downward sloping demand curve for this individual iced coffee shop's iced coffee. Where now we're considering their leftward shift in their demand curve that they face due to the rightward shift in market supply. This then generates a new marginal revenue curve that's strictly below our new demand curve for this coffee shop's iced coffee. Going through the profit maximization process, this then corresponds to looking at when marginal revenue is equal to marginal cost, which corresponds to an output level QG, where since this firm has market power, they then price using this output level on their demand curve, which is going to be the later demand curve that they face, giving us a price point PG. Where now in terms of determining profits, this is going to be looking at price minus average total cost, where here we observe that our pricing strategy, that is the point on our demand curve for this iced coffee shop, intersects our average total cost curve. So this means price minus average total cost is going to equal to 0. So 0 profits per unit, such that when we scale that by our quantity level, there will be 0 overall economic profits for this individual firm. So then what we saw then is with a short run equilibrium in which marginal cost is equal to marginal revenue, since positive economic profits existed and there's low barriers to entrance, new firms entered into the market, which pushed down the price for the overall market of iced coffees and increased the quantity levels. But what this did to the overall for an individual coffee shop in the space due to leftward shift in demand that they face is it pushed down their profit levels until it reached 0. In that they faced a new demand curve that intersected their average total cost curve, such that the condition for this long run equilibrium is going to be when marginal revenue is equal to marginal cost is equal to average total cost. Where the thing to observe though is that this intersection did not occur at the minimum value of average total cost. And then so to reiterate once again what went on in terms of this adjustment period in terms of the market as well as the individual firm, the new equilibrium allowed for a higher output level and lower price point than before for the overall market of iced coffees, and for the individual firm in terms of their profit maximization process, it pushed down their profits in terms of reducing the price point of their iced coffee as well as output levels. So then, to get a better idea in terms of the short and long run equilibrium for an individual coffee shop, let us look at both of them briefly. Where on the left, we have our individual coffee shop in the short run, and on the right, we have our individual coffee shop on the right in terms of the long run. Where in the short run, examining when marginal revenue is equal to marginal cost, this gives us a quantity level QA in terms of our profit maximization bundle. Pricing along our demand curve corresponding to point F, we see we have a price point PA. Price minus average total costs is positive, such that there's positive profits per unit, such that positive economic profits overall exist for an individual firm. Since new firms then enter due to this incentives that they have and low barriers to entry, market supply shifts to the right, and market supply will continue to shift to the right, pushing down price as well as increasing the quantity levels for the overall market, which will have the effect of continuing to push the demand curve in individual coffee shop faces to the left, such that when they go through the profit maximization process, when marginal revenue is equal to marginal cost, they'll see they'll have a reduced quantity level, and in terms of their pricing strategy, they see that they'll be pricing at the value of average total cost, which leads them to have zero economic profits overall, since there will be zero profits per unit. So then, with this outcome in mind, in terms of the short and long run equilibrium for the overall monopolistic competitive market, and what that means in terms of profit levels for an individual firm, let us now compare the monopolistic competitive market to that of the perfectly competitive market structure in the short and long run. Beginning with the short run, monopolistic competition on the left, perfect competition on the right. In terms of our market outcome, we're going to be looking at marginal revenue intersecting market supply or industry marginal cost, giving us our quantity level IC1. Pricing along our market demand curve, this corresponds to a price point P1. How this translates into perfect competition, we're just going to be looking at the intersection of market demand and market supply, which we see corresponds to a output level IC2 and a price point P2, where IC2 is strictly larger than IC1 and P2 is strictly less than P1. So in equilibrium, the perfectly competitive market structure leads to a higher amount of output at a reduced price point, and a consequence of this also is going to be a higher amount of consumer surplus than the monopolistically competitive market structure. So then overall, graphically, what we saw, to reiterate, was in equilibrium, the perfectly competitive market structure in the short run leads to a higher amount of output at a lower price point in which there's a higher amount of consumer surplus, where individual firms maximize their profits at the rate of price is equal to marginal revenue is equal to marginal cost. Whereas for the monopolistic competitive market equilibrium, we saw that there was a lower level amount of output in equilibrium with a higher price point in which higher levels of economic profits were possible, and firms maximized profits at the rate of marginal revenue is equal to marginal cost. Now, examining the long-run equilibrium for the monopolistically and perfectly competitive market structures, let us consider when new firms enter into the market. So in the monopolistic competitive market structure on the left, we have new firms entering into the market, so we're going to consider our later market supply curve. At the intersection of marginal revenue and market supply, this gives us our quantity level, and moving up in terms of our pricing strategy along our market demand curve, we see we have a price point P3, where overall we have an increased level of output at a reduced price point. And how this translates to when we're examining the perfectly competitive case, we see that with new firms entering, this also corresponds to a rightward shift in market supply, in which, looking at the intersection of new market supply and market demand, we see that we also have an increase in quantity and a further reduction in price point from P4, where the increase in output for the perfectly competitive market is going to be greater than that of the monopolistically competitive case, and our price point P4 is going to be strictly less than P3. So this also entails still a large amount of consumer surplus for the perfectly competitive market case. And in this case, since we're looking at the long run, we have zero economic profits for both markets. Where overall what we saw in the long run was that the perfectly competitive market structure in equilibrium led to a higher level of output at a lower price point in which there was a higher amount of consumer surplus and zero economic profits existed, where individual firms were maximizing profits at the rate of price is equal to marginal revenue is equal to marginal cost is equal to minimum average total cost. Whereas the monopolistic competitive market structure in its long-run equilibrium state had a lower level of output and higher price point compared to the perfectly competitive market structure, in which this industry also had zero economic profits and firms were maximizing profits at the rate of marginal revenue is equal to marginal cost is equal to average total cost. And overall then, in equilibrium, the perfectly competitive market structure leads to a higher amount of output and reduced price point in which higher amounts of consumer surplus existed in both the short and long run, whereas the monopolistic competitive market structure led to a higher amount of economic profits in the long run, but both market structures led to zero economic profits in the long run.